Good afternoon, everybody. Good evening. My name is Kevin Wright, and I'd like to welcome everybody for coming out to this meet and greet on behalf of SusGlobal. We have about probably 30 of us that are in the room here today, and we have about 30 people that have joined us online as well. So thank you very much for coming out. The agenda that we have scheduled for ourselves this afternoon is we have 3 presentations that we're looking forward to presenting to yourselves. The operations of the company over the course of 2023 and what some of the opportunities are in the pipeline in 2024. We'll be talking a little bit about some of the financings and the means to get there, and talking a little bit about probably what's most interesting then is the valuation of that in terms of our market capitalization and as fellow shareholders to the company in terms of being able to update you our pathway to get there. So just in terms of like a little bit of housekeeping, just so everybody is aware, we're recording this for the purposes of being able to share it with our fellow shareholders that were unable to join us this afternoon. And also that we'll have a question and answer period at 5:30. And we've already received probably about a half a dozen questions that have been coming in through the chat channel on Zoom, and probably another 3 or 4 questions that have come in via email in advance. So we'd like to thank everybody for that as well. And we'll do our best to address everybody's questions today. So I guess then, without further ado, there's certain information as a public company and within our governance, and in speaking with our attorneys before we put any information out to the public to give all to provide a fair market for all of our shareholders. There's information that we have published, and we're here to share that. We're also here, of course, as directors and managing executives of the company to share with you our opinions and insights and the impact that we believe they'll have on the future of the company. There is, however, information as well that we're subject under mutual non-disclosure agreements that at this time, there may be information that we're not able to share, and it isn't in the interest of not being transparent. We believe as a public company, and the reason that we're having this meeting today with yourselves and providing this information in recording format for other shareholders that were unable to attend, is for those reasons of good governance, fair market, and so without further ado, I would like to introduce Bruce. Bruce is an independent director with SusGlobal. Bruce is a professional engineer here in Ontario and a number of other provinces as well. He's also an accredited independent director from the Rothman School of Business. Amongst many roles and advisory positions, Bruce has served us also with our by providing advice and advisory around corporate governance. In addition to his background, Bruce was a senior vice president of Veolia, which is, for those of us that don't know, Veolia is the world's largest engineering company with over, not to speak too much about Veolia, but they're a large and important part of it. And Bruce was the senior vice president of operations in North America, and has been lending that advisory to us as we move to scale up our facilities. So Bruce. And Bruce, I'm just going to push this in front of you, and I'll allow you to do that. Aiden, is that coming up? Aiden, is that showing up as Bruce in the picture?
Okay.
We're good to go.
So I wanted to just do an operational review and a little bit of a roadmap going forward in 2024. And I thought the information I wanted to share, it would be better just to start out talking about what our strategy is, so that it kind of refreshes your memory of the various components of the business. So our strategy is to be a renewable organic waste to regenerative product producer. A lot of fancy words, but what we're intending to do is to manage organic waste, waste food from residential, and through a process of collection managed by others. We're not a transportation company. We're a processor. We will take that organic waste and produce a number of products. And they're called regenerative products because the material that we're using is being reused. It's a waste that we're creating a beneficial reuse. So sources of the organic waste, certainly residential green bin programs, which you're probably familiar with. I live in Oakville. We have a green bin program. And other commercial and industrial producers, restaurants, hospitals, schools, food producers and food processors are also sources for us. The products we'll produce, we have 3 of them. We have an organic compost fertilizer. We have a pathogen-free, organically certified liquid fertilizer for organic food production. And we intend to have renewable natural gas, RNG would be our 3rd product. We are a credible ESG provider. ESG is a environmental terminology for circular economy companies that are reusing waste for beneficial reuse. And we produce products that in our realm of operation, we produce products that produce byproducts. For example, when we produce compost, we generate a leachate. It's a material, a liquid material that comes out of the compost material. We use that leachate to produce liquid fertilizer. We're going to be running RNG facilities that produce a liquid and a solid byproduct, a waste, that we will incorporate into our liquid fertilizer. So that circular economy concept is in full bloom at SusGlobal. A very important part of our story. For a lot of reasons. First of all, there's a great cost advantage to be able to reuse your waste from producing a product in other products. Cost of disposal, cost of managing that product. And it's also important for us as a player in this market is to be able to talk about how much are we contributing to the landfill issue. Very little, less than 2 or 3% of the waste that we receive will end up in a landfill. Typically contamination in municipal source separated organic material. The green bin programs become a bit of a depository for a lot of other contamination that we would just send to landfill. We can't deal with that material. So a very great business model. We get paid to take the waste. We get paid to sell the product. We get paid for carbon credits that we sell to the marketplace. We've developed a strategically positioned network involving 2 facilities, one in Hamilton and one in Belleville, that are located adjacent to growing population bases. West end of the GTA is growing pretty rapidly as housing cost is moving people further west. And our location in Belleville is right on the edge of the GTA where there's a lot of expansion, new neighborhoods, new communities being created out there to deal with the housing. So we're feeling pretty positive about the location of those facilities. Equally important, many of our customers require redundancy in our processing. Got to have a second facility in case the one facility is not functioning. So both the Belleville and Hamilton operations will be able to offset a problem in the other plant if so. It's only 250 kilometers from one facility to the other. We can divert materials to the operating facility if we have a problem with one of the facilities. We intend not to be a transportation company. Many people in the waste business run big fleets of equipment to collect waste and then they're processing. We don't plan to do that. We're just going to be processors, and we will leverage relationships, transportation relationships we currently have with some of the biggest players in the market. So that's again, an important differentiation in our strategy. We currently have environmental compliance approval at each of our sites, and these are important. They're very hard to obtain. We intend to work with the ministry, who is quite interested in accommodating our changes to our ECAs to expand our volumes, to change the amount of waste we can have on site at any one time in our facility. And we need more volume in each facility as we intend to add anaerobic digestion to both Hamilton and to Belleville. And we need bigger volume permits to do those expansions. So these slides, the first facility, the slide is the Belleville facility. Again, just to overview who we are out there, we have 49 acres. This property is 2.5 kilometers from Highway 37, which is an important metric. The gas pipeline in that part of the country runs down Highway 37, and we're 13 kilometers from the 401. So good location from a transportation perspective. We're permitted to handle 70,000 metric tons a year of compost and 50,000 metric tons of construction and demolition waste. So total capacity at that site is 120,000 metric tons a year. The compost operation is active and revenue generating on that site. It consumes about 13 of our 49 acres. We currently process around 15,000 metric tons a year of organic material into compost. We generate about 5,000 metric tons of compost material that we're selling to the market, mostly agricultural sales. And we're selling that product at about $40 a metric ton. So we inbound the waste at about $90, $95 a metric ton. And we're selling a third of that volume out as compost. It's a 3-to-1 kind of ratio on processing compost. We have a number of customers that supply that. They're all very local, small towns and municipalities. Hastings County, Prince Edward County, North Cumberland County. We expect to expand that customer base as we start to increase and improve our operation in Belleville. We intend to upgrade our compost operation in 2024. We are going to eliminate receiving biosolid waste, which is a municipal waste out of the bottom of digesters, because it doesn't allow us to maintain our organic certification on our products. But also, if we eliminate the biosolids, we can get to a AA compost, which is more valuable to the marketplace. So we intend to stop receiving biosolid waste. We are going to upgrade our pre-treatment process, which is when you dump the material in your tipping room, you process that material basically to remove plastic bags. Improves the quality of the compost material. And we're going to install a bagging operation to start to produce AA compost to sell in the retail market. A 20 kg bag of compost, AA compost, sells for about $9.50 a 20 kg bag, which is the equivalent of about $400 a metric ton. So we're going to go from $40 a ton to $400 a metric ton by doing these improvements to our compost business. We also intend to install one unit of our liquid fertilizer processing business in Belleville to manage the leachate that comes off of our compost. Right now, we're hauling that leachate to a water treatment facility or to another processor. We will be able to deal with our own leachate at that site with our processing unit. And we intend to enter into an agreement. We're currently negotiating with a strategic partner to operationalize our construction and demolition transfer station that can take 50,000 tons a year. This particular strategic partner is permitted to haul organic waste. He's a trucking company, as well as an infrastructure, construction, and maintenance contractor. So great partner to have on site. He runs a vacuum truck fleet. He's going to be a strategic hauler for organic waste for us, right on our site in Belleville. And he's able to provide some maintenance services at site. He's going to have equipment and men at that site. So we're going to be paid $50 a metric ton of C&D that comes in. Tipping fee is around 100. So we're going to get 50% of that as his fee to be on our site. So we're going to start to develop some cash flow from the Belleville site, improving our compost business, and also monetizing the C&D permit that we have. Just going to change the slide. This is a slide of our Hamilton operation that's currently in construction. We have 3.3 acres of M5 zoned industrial property. M5 zoned property probably doesn't mean much to you, but this is the most favorable industrial zoning in Canada, certainly in Ontario. I've heard the ministry describe an M5 zoning. You could build a nuclear reactor on that zoning if you needed to. It's very broad, very accommodating to volumes and processes. So we have 3.3 acres of M5 property adjacent to the Red Hill Valley Parkway and the QEW in the north end of Hamilton. So great location for transportation purposes, as well as to run a business like organic waste. We're not sitting in the middle of a residential area. This is heavy industrial all around us. So it is very supportive of the kind of business that we want to get into that in that area. We recently completed, you probably saw the news release where we purchased the adjacent 2 acres. So we have a total of 5.3 acres of M5 zone property. It's all fully permitted. Currently, our permit is for 65,000 metric tons a year of organic waste. And the facility we're constructing there is our liquid fertilizer operation in that building. And we're about 25% complete. We intend to have that construction completed on that fertilizer unit, probably third quarter of 2024. And in business operations, cash flow, late 24, early 25. The most interesting part of our plans for this business is the introduction and development of anaerobic digestion in both of the facilities in Hamilton and in Brantford. It's a logical add, a product add to the company because it is an attractive product. Renewable natural gas is probably the favored replacement fuel for fossil fuels. And the COP28 in Dubai announced that they're going to start to focus on phasing out fossil fuels, which is going to drive the market towards the alternative fuels like renewable natural gas. So great news. And in addition, there's a cost advantage to run an AD unit. The AD unit provides a product that is quite attractive in the market. We're in the process of negotiating an offtake agreement for our gas, and we're starting to see what the market pricing is and the opportunities for us financially. But also the digestate, which is the byproduct of anaerobic digestion, becomes an input on our liquid fertilizer, both the liquid digestate and the solid digestate. We can turn that into liquid fertilizer, which reduces our cost of byproduct management on RNG, but also reduces our cost for management of solids and landfillable materials. So we think that anaerobic digestion brings a number of very interesting opportunities for the business, incorporating our other products that we're going to be producing. To give you an idea, RNG is expected, well, in 2022, the RNG market was $110 billion US in sales. And by 2030, 6 or 7 years down the road, the market's going to be 215 billion. It's going to more than double in 6 years. So we're quite encouraged to be entering the renewable natural gas market right now because the growth in the gas requirement, as well as the diversion of organic waste out of landfills and regulations such as any town greater than 5,000 population is required to put a green bin program in, which is going to start to divert a lot of organic material that is being disposed of in solid waste streams, the curbside garbage pickup. There's a lot of organic waste that ends up in that stream. So the regulations are coming our way. The markets are coming our way. RNG is going to be a great add for the business. We intend to design, construct, and operate a 90,000 metric ton per year anaerobic digester at each of the 2 facilities. And we have started to analyze the process design for this operation. There's a couple of major technologies available on the market. My previous experience with Veolia was responsible for the City of Toronto's Disco Road operation that utilized a wet system, which is the addition of water to the source separated organic, the material that you receive. It's a better way to process the waste because you can separate plastic and contamination because they're floating in a water environment, and it allows you to better pump the organic material that's been cleaned in the process. So we intend to use the similar system to Disco Road, a wet system. We intend to upgrade the biogas that's produced by the organic waste in the anaerobic digester. We're going to upgrade that biogas to our pipeline grade RNG material right on our site. We have technology that we're going to install beside the digester. We have been in discussions, as I mentioned, with an RNG off-taker. And it's important to understand that part of our negotiations, which is a complicated process, involves the construction of a 2.5 kilometer pipeline from Highway 37 up to our site. And in Hamilton, we have a gas pipeline right on our property line, so not much of a problem connecting there. Feedstock supply is the most critical issue in this business. You would not construct an anaerobic digester or a composting operation if you could not source waste material. So we have currently some pathways of waste coming into Belleville through the local communities. And we will need to use a lot of effort and time of the management team. A 90,000 metric ton per year anaerobic digester is going to consume 3,000 30-ton truckloads of waste at each of one of those facilities. That's going to be on a 5-day-a-week operation, receiving operation, 12 to 13 truckloads a day in each of those facilities of organic material. That's a lot of material to source. So this is going to be our critical challenge operationally, is to get the feedstock commitments in place under contract, and also the logistics on our site to handle that volume of waste. We expect to commence marketing and bidding activities on municipal contracts in Southwest Ontario, Eastern Ontario, Western Quebec, and our Belleville permit allows us to draw materials out of New York State. So we're going to be focusing on those markets for sourcing of organics. The second most important challenge in running this business are the offtake agreements. I've talked about the RNG contract. We're in negotiations. We have been for several months with the largest natural gas and RNG operator in North America. And we are negotiating a contract that would address the gas produced in both facilities. We're combining the volume for a 10-year period. We've reached the stage of negotiations where we're going to be required to commit to legally binding performance metrics for gas production, quality of gas, and a commitment to the operational start date. So we're in the process of working with our strategic partner Veolia to develop more confidence in these performance metrics. This is a very important stage. This is going to take a little bit of time to do because we have not done any detailed engineering on the anaerobic digestion. We're modeling off of an existing facility, which is not giving us the level of comfort that we should have to sign almost $200 million 10-year contract. So we're taking a little bit more time to get through this offtake agreement for good reason. We do not want to have a financial problem with a very well-built anaerobic digestion. It just got the wrong pricing or wrong terms and conditions. So we're taking our time to make sure that's correct. We are in discussions with several other strategic partners beyond Veolia. There is a number of players that we've been talking to for probably over a year now. But you know, I see 5 strategic partnerships that we're going to be working to put in position. Feedstock supply. We're currently doing this internally. Mark and the on-site folks in Belleville are soliciting or responding to requests to receive waste. We intend to migrate that into an engagement with a marketing consultant, somebody that's active in this market, and there are lots of folks that can provide the service that know where the contracts are. We're going to engage somebody to be our strategic partner. I've talked about the RNG offtake agreement. We're currently negotiating definitive agreements, and we expect to see that finished early in 2024. Our technology and operation and maintenance partner is Veolia. We're negotiating a letter of intent. We should have the results of that negotiation sometime next week. We're negotiating with a transportation strategic partner because we're not a transport company. We're negotiating an LOI with that party right now. They have an interest in our transfer station. We have an interest in them being our transportation arm. And fertilizer sales and marketing, we have offtake agreements we require for compost. We're going to be generating a lot more volume of compost as well as liquid fertilizer. So we're going to be looking for retail, wholesale partnerships that we can move that product through them to the market. I really don't have any other specific information. I look forward to questions. I've been fielding a bunch of questions before the meeting started, but looking forward to hearing some of your concerns.
So right after the next two presentations, guys, we'll do an open question and answer session. So if you have any questions, we'll just save them to them. It would have been my pleasure to introduce Andrea to everybody. However, those of us here from Toronto know what Toronto traffic is like. Andrea, I think, is still on the Gardner and hasn't arrived. So hopefully you get to say hello to him shortly. But in the interest of keeping this going, I will try and fill in on some of the slides that Andrea was going to be speaking to us today. And in fact, at 4 o'clock today, we made an announcement. Andrea, as we see here, is a director of the company, just by quick way of introduction, in absence. And he's been working with SusGlobal now as a director and an advisor and a consultant for almost 7 years. He's a fellow shareholder, like yourselves, like Bruce, Mark, and myself. Bruce is a seasoned and an experienced financier, having worked as a director, an officer, and at a C level for both capital markets companies and finance companies, and was awarded top 14th fastest growing company in Canada. In addition to that, he holds an MBA. Sorry, you'd think the font was large and I could read it without my glasses, but a Bachelor of Architect. He's a professional land economist and is a member of the Royal Architectural Institute of Canada, where he also was privileged to serve as the president of that esteemed organization for 14 years. And hopefully will join us soon. Andrea and Ike, our CFO, we're going to be speaking to you about financials and financing, which as shareholders is obviously instrumental, and explaining to everyone then in terms of the choices and the selection that we need to make as a company and to serve the value for our shareholders. So we're going to speak a little bit about that to you today. So strategic funding, it comes in a number of different ways, and actually I might present this a little different than Andrea. So I'm just going to go to the financial benchmarks. So all these great things, that we have that are existing right now, and the millions of dollars that have been invested in us, and how we've been able to deploy that in the acquisition of the properties, to acquire the licenses, to build out our facilities in Belleville, and to put that into revenue, has allowed us to de-risk the model, complete our phase 1 growth, and look at attaining phase 2 growth. So part of our inherent infrastructure, as Bruce had articulated, is in the upcycle of organic waste. So people are paying us to take these products, which are our products, to create this renewable natural gas as a byproduct from our compost operations, to which Bruce alluded. We announced 2 months ago that we were in a purchase and sale agreement and are working through a definitive agreement for that. How do we build this natural renewable natural gas facility? And recently, when Bruce was explaining to me the model, it's about $1,000 a gigajoule. So
No, $1,000 a metric ton processed.
$1,000 a metric ton process. So at the numbers that we're talking about to build out the Belleville facility for this is $112 million exercise. And the contract that was announced 2 months ago is a 10-year contract for $180 million. So the life cycle of a facility of this magnitude is well into the 35, 45-year plus range. So the economics behind doing this, and I'll just skip back and forth between these two slides, puts us into not the first category of equity, which is how, as many of us are early investors, the company was formed 10 years ago by our founder and CEO, Mark. And over that time, we had sold equity stock and we had done debt financings to allow us to acquire these properties. But to get to the next level, we'll be looking at different types of financings. And I believe it was Andrea and our intent today to share with you the sophistication of some of the levers and the dials and the instruments that now become available with the type of partners like Veolia, who we mentioned, which, you know, is a publicly traded company, and in fact is on the OTC markets listed here on a previous slide. Last year, that company did 26,800 billion euros in annual revenue, or 26.8 trillion billion euro. So an incredible partner to have, 220,000 of 220,000 employees that have built and maintain similar RNG facilities here in Ontario and here in the Greater Toronto area. So in partnering with them, when we look at some of the financial instruments that are required for these types of bank feasibility investments for under our CapEx and asset, they come in the form of loans against the engineering of these, which is why things like when we announced our definitive agreement that we were in the final processes that have not come to completion is because of the required appendices or due diligence that are required for this type of a technical project to be executed. But once executed and in place, those are the same compliance documents that are required by tier 1 institutions that allow them to make investments into these CapEx. But, you know, in essence, are putting them in position against the $100 million worth of property, license, and technical and mechanical hydraulical infrastructure located there. Much like if we were a mining company, a 43101, as you move through the process, allows you access to different financing vehicles. So part of the financing discussion that we wanted to have with the shareholders in our original structure, and I think it was done quite smartly, we have an authorized amount that the Treasury is able to print. We've issued and outstood a number of restricted and free, and of course, most of those shares are existing now inside of the float. So when we look at our financing benchmarks again, as we move forward, some of you may not know, but after market today at 4:01, we announced that we had signed an agreement that we've been working on now for a number of weeks with Oak Hill Financial. Oak Hill Asset Management is a Toronto-based exempt market dealer that is, we've now formally engaged and made announcement after market today for our equity financings that we're working on. The closure date for that is anticipated to be in February 15th. Part of our job will be to communicate to yourselves where we're allowed to on a more frequent basis between now and then, the success of these mutual activities. So the mezzanine or the bridge financing to get from where we're at today to retire some of the convertible debt that we have, to pay out some of the mortgages that we have. Oops, excuse me. Look at that, Mark. I just threw it right over to you. Hang on. I meant to go back. So where we were, sorry, I'm trying to be mindful that I'm also on camera for that home audience. Andre should have presented from at home, then he went. So where we'd moved from our equity investments that we all participated in early, to where we're at today, then in terms of mortgages and lines of credit, and these mezzanine financings allow us to get to supplier and vendor financing for the types of equipment that will be installed in Belleville. It allows us these offtake agreements that we've been speaking of, these purchase and sale agreements. These are basically a pay or no pay. They're definitive oil and gas and energy purchase agreements that are bankable, and that's what allows us to secure the financing as we're moving forward. So we're sharing with you some benchmark examples of these financings, and they'll be done with our shareholders in mind. That when I spoke earlier then about the authorized, so as a company, we're authorized for approximately 150 million shares. We have about 120, 125 million that are issued and outstood today, which allows us a treasury of 25 million shares. And I think that's an important number to share, because we would be calling an AGM meeting to try and increase that. But at this stage, we see we don't believe that we have an interest in increasing our authorized. We think that we've now, with your support to date, have been able to get ourselves to that next phase, that we will be able to secure non-dilutive type financings, and we hope to report back on this. That's our desire. That's where we're trying to go with this. And we know we've got a number of people in the audience here today, or at home as well, that are very sophisticated in terms of institutional and some of the instruments. Certainly, as Bruce mentioned, we have 40 staff at one facility, but we're probably a staff now of about 60. And I've got a trunk load of t-shirts that say SusGlobal. We need more people on the team. So if anyone has any ideas on terms of our CapEx and assets and debts, I mean, these are the types of conversations that we're having now with Oak Hill as we're moving forward. And it most likely will be a combination of each, and we look forward to sort of reporting back. So Andre, hopefully, will be here to answer any of the questions that I might have set him up for. And the interim of that, though, I'd like to introduce to those of you who don't know Mark Kazout, the founder of SusGlobal and our CEO. Like yourselves, Mark is a significant investor in this company, having founded it and actually participated in buying shares of the company over the course of the last year to help support all of us here. All of those you'll see filed under a Form 13, every purchase that Mark has made to support our efforts and our intents. And we thank him for that. And also, as a director and insider of the company, of course, Mark has the privilege of being first in and always in and last out. So we thank him for that as well. Mark, without further ado, maybe I'll let you. Mark's talk today is a stock talk, and the public company strategy unpack.
Thanks, Kevin. So first of all, I want to thank all the shareholders that are here today and that are online. The comment that I most often hear is we love the company, we love the model, we love the the circular economy aspect and so forth, but where is the funding to execute on the plan? And that's a great question. And I'm going to go back to about a year, just over a year and a half ago, when we had a registration statement that cleared. We were ready to go effective. We had an underwriter at the time, Spartan Capital. They wanted us to, we were an $80 million market cap. Share price was at 80 cents. They wanted us to effectuate a 1-for-10 reverse split. So it would have put us at $8. Then they wanted to complete the financing, the $15 million financing that we had announced at $5. So another 40% discount. Now that would have been extremely dilutive to the shareholders. And in hindsight, I think it was, we didn't capitulate. And in hindsight, that was the best thing we could do for the shareholders. Because if you look at a lot of these micro caps that did uplist, they're all facing challenges of meeting their minimum bid requirement, and they're having to consolidate, and many of them have consolidated several times. So we have not done that. We've maintained, so we have no preferred shares issued. We have no warrants and no options outstanding. This is very unusual we used to be a development stage company. Now we're an emerging growth company, but that's very unusual for a company of our size. But we were able to maintain the common shares only, and that's very important to note. because I think there's a disconnect between the true intrinsic value of our assets and the share price. But that's not unusual. There are many publicly traded companies that trade even below their own cash on the balance sheet or cash on hand. So in our case, when we look at our real estate, and we own the real estate, we own the real estate in perpetuity. What's important is these licenses, the environmental compliance approval licenses that are attached to the real estate. They're not transferable. There's a significant intrinsic value in those licenses, probably more valuable than the real estate itself. So having said that, it allows us, first of all, first to market. You cannot, in Belleville, we have a 49-acre facility with an ECA, the Environmental Compliance Approval License, to process 120,000 metric tons of organic waste. You cannot come along and acquire or purchase 49 acres adjacent to us and think you're going to open your own processing facility, because the ministry is not going to issue you the license. And the same thing with Hamilton. We have a facility there that's 5.5 acres now of M5 industrial, which is very valuable and very rare. There we have an environmental compliance approval license to process 65,000 metric tons per annum, and we've already spoken to the ministry about increasing that, and there's no issue as long as we continue to, stay in compliance and maintain our ECAs. So in total, we have now 185,000 metric tons of organic waste processing capacity within 250 kilometers within the GTHA, the Greater Toronto Hamilton area, which the province of Ontario, it's 18 million is the population. That's almost half the population of the country. So we can really draw on all those organic waste streams. Back to the share price. So now we have the option, because the real estate is so valuable. And I'll just give you a quick example. When we bought Hamilton only just over 2.5 years ago, we paid $750,000 per acre. Now the value is over $2 million per acre. So when everyone wonders, well, how did they manage to operate for these last few years? We haven't raised any money in probably over 1.5 years. We've been able to leverage the equity in the real estate. And that's how we've been able to continue the operations. Now, we're not a pre-revenue company. We do generate revenue, but keep in mind that it's very expensive to run a public company. Probably costs us almost $1 million a year. We have the auditing. It's we're a fully reporting U.S. issuer, so that's U.S. GAAP, expensive auditing. Then we have U.S. counsel and Canadian counsel, U.S. Security Counsel. And then, of course, we have all the filing fees. So that alone really does impact, the cash flow. And then, of course, servicing the debt, servicing the asset-backed debt, which is the mortgages that we have on the facilities. So that brings us to answering the question, where is, the financing to execute on the plan? So today we, as Kevin mentioned, we signed and we press released and we announced that we've signed an exempt market dealer distribution agreement. So the idea is, and we didn't announce the amount, but I will share it with you because it is in the agreement. It's $35 million. So now that's not an arbitrary number. The $35 million breaks down like this. Originally, the $15 million is what we've always, that's not an arbitrary number. We've always wanted to raise the $15 million. That allows us to meet shareholders' equity for the NASDAQ listing. And then, of course, the use of proceeds, complete the Hamilton facility and start processing there. The additional, so that's about 20,000, 15 million US, about $20 million Canadian. The additional $15 million that we're raising is to pay all this asset-backed debt so that we have a clean balance sheet. Because then we could offer the accredited investors or whatever structure we ultimately decide, which will be, I can assure you, non-dilutive, we can give them a basket of assets that are free and clear. And that's how we're going to be able to fund to clean up the balance sheet, fund the development and completion of the Hamilton facility. and get us to the next step in or evolution in the market, and that's uplisting to NASDAQ. Once we're on the NASDAQ, we already are engaged and and are committed to H.C. Wainwright, our underwriters, for a follow-on once we're on the NASDAQ. Because the next question should be, well, how are you going to raise this, $100 million to build an RNG facility? Well, the CapEx is coming from that follow-on financing, which we don't need all in one. It could be done in tranches because it'll be built over time. So these are the questions the answers to the questions when it comes to how are we going to execute on the plan? It's important to know too that when we're very careful with structure of the share structure, corporate structure. It's very important. We're careful with dilution. I'm a shareholder like you are. So we're very careful. When do we take these tranches? Even with the exempt market dealer, $35 million raise, it doesn't necessarily mean that on day one, we're just going to take $35 million. We may take it in tranches as the use of proceeds are required. So it's important because I know that as shareholders, the only gauge you have is you look at the share price every day. And if the share is up, great. Share is down, not so great. But I can assure you that we have received unsolicited offers for our real estate that are 3-4 times our market cap, which tells you that there is a disconnect, but that's okay. Because when we do uplist to the NASDAQ, then we're going to be valued by fundamentals, right? The market doesn't really care that we own the real estate. They want to see revenue, cash flow, EBITDA, net profit per share, etc., return on equity. However, that will happen once we're on the NASDAQ and we're monetizing and developing these assets. We will get there. It's almost like the banks in the 80s when they owned all the real estate on every corner. They sold all the real estate because the shareholders didn't. You could be a tenant for all they care. They want to see return on investment, and that's fine. Right now, our real estate is extremely valuable, and we will monetize the real estate. That's why we have all these strategic partners that are coming to us. That's why we have all these unsolicited offers coming to us. So I can assure you we could probably monetize these assets and dividend out maybe $1 a share to everyone. But I don't think that everyone's been waiting a very long time to be able to see us develop and monetize these assets like they are supposed to be. It's a circular economy model where we regenerate the organic waste to produce these regenerative products that are in demand. Now, keep in mind too, that those 3 revenue streams, the tipping fee, the sale of the products that we produce, we also have the carbon credits. Now, everyone talks about carbon credits and cap and trade and so on. Not too many, and certainly not too many publicly traded companies are able to monetize their carbon credits. We have. Our Belleville facility is listed on and registered on the CSA GHG Clean Projects Registry. And we're able to prove up these, this is from the diversion program, meaning every ton that is diverted from landfill and we process, we're able to create these what's called VERs, they're verified emission reduction credits, and we sell them and market them, and we sell them to large corporations that need to offset their own carbon emissions. And you can see that it's in the link that in many press releases we've shared with shareholders, and you can see how we continue to monetize carbon credits. And this is very important because and we'll do that when Hamilton is operating and we're diverting there too. This is very important because when you look at the RNG as well, with these offtake agreements, the environmental attributes are so valuable. I mean, gas itself, maybe $4 or $5 a gigajoule, but we're looking at getting $30 a gigajoule. That's all environmental attributes. Very, very important when you're serious about the climate change. And, you have COP28 that just took place, as Bruce mentioned. These are the initiatives. We have to reduce greenhouse gas emissions. And how do you do that? You have to have these sustainable solutions to divert organics from landfill. As a matter of fact, landfills are being shut down. or landfills there are strict parameters that the governments, they're legislating this. So we are going to benefit from the having the infrastructure to be able to process all these volumes of organic waste stream, which becomes feedstock to us. We don't have supply chain issues. We're producing fertilizer. The food stream is coming to us. So we don't have to worry about potash or any conflict in anywhere in the world that impacts our supply chain. We have the feedstock. We get paid to take the feedstock. We regenerate it, produce liquid fertilizer, compost, dry compost, ultimately RNG, and then we monetize the carbon credits. What's important about this initiative for the RNG is you have a self-contained. Everyone was under the impression that, oh, are you going from fertilizer to RNG? No, no, no. These RNG facilities are being built adjacent to our fertilizer production and facilities, because to have the loop, the circular economy model, that loop is taking the digestate that comes out of the digesters, that's what you have left in the anaerobic process. We take that into our fermentation process and produce more liquid fertilizer. So you've got this self-contained, pure circular economy model, and you have a sustainable solution for organic waste that's being diverted from landfill. This is how you're going to create value for the shareholders. You have to monetize these assets, which we now own in perpetuity. These are not like leases with municipalities for 30, 40, 50 years. We own the real estate and we own the licenses that are attached that are non-transferable. They're extremely valuable. So I think with regards to the share price, again, we've today made it very clear on how we're going to execute, and we will continue to execute so that eventually the share price will catch up to what we're doing, whether it's to reflect the true intrinsic value of the real estate or eventually be valued based on fundamentals, because we will have analyst coverage and they will start looking at our performance and our models, and then we'll be valued that way. And then they'll give target prices and say, well, based on these on the performance and so forth, this is where the share price will be 12 months, 24 months, and 5 years out. So I'm looking forward to answering questions. I think that one last comparable that I want to make at this time is a company called Divert. It's a private company, and Enbridge has made a significant investment in Divert. Earlier this year in March, they invested $80 million for a 10% interest in a company called Divert. So they gave them an $800 million valuation. Now, Divert also signed a 10-year offtake agreement with BP, about $175 million. But what Divert does is very interesting. They collect organic waste from over 5,000 retailers across the United States, over 10 states. So all the logistics to collect all this organic waste from mom and pop shops and other organic streams, and they collect it. Now they're collecting 230,000 metric tons per annum. Now, when you compare that to our existing capacity of 185,000 metric tons, and we don't have those logistics. I mean, can you imagine collecting from 5,000 retailers over 10 states and the trucking? It's quite a feat. But because they've got that feedstock, they now have entered in this agreement with Enbridge, and Enbridge has committed $1 billion for them to build the infrastructure and these RNG facilities across the United States to take this organic waste stream, regenerate it into RNG. So you see the potential that we have. We don't have that hauling and infrastructure and collecting. We have municipalities that are bringing in their green bin program, the source separated organics, the SSO that from our green bin program. So the potential for us to be at that type of valuation is extremely high. So it is in my opinion that once we do start this $100 million run rate that we anticipate in terms of revenue, in this sector, you can have a 20 multiple. We could be a $2 billion market cap when we're able to execute and start generating those revenues, monetizing these and developing these assets to be at capacity and to leverage not only the equity in the real estate, because we're still in land assembly mode. This is very valuable. What's important to note is when we started out in Belleville, for example, we had 13 acres with the license on 13 acres. But when we acquired the other 36 acres, now we're at 49 acres, the license merges. So we don't say, well, we have 13 acres and it's licensed. We have 49 acres licensed for 120,000 metric tons. Same thing in Hamilton. It was 3.26, now it's 5.3 with the license. So, and as we continue on this land assembly, it grows. So we're creating more value with the land assembly, we're creating more value with the merger, and those licenses are the intrinsic value is extremely high. So we monetize the license, the share price will catch up. Lastly, we are just at the end of this. Before I was here, there was, there were convertible notes. We're seeing the last of, we haven't had any conversions since March of this year. And we're seeing the last of those convertible notes that had any shares that were in the system. I think we're seeing the last of it. So I think from here on, certainly with this financing that we've announced, I think we're going to now start seeing the share price. I feel very confident that over the next quarter that we're going to see us maximizing value for the shareholders.